cusp of the next quarterly earnings season in the USA, which will get going in earnest when the megabanks JP Morgan Chase, Citigroup and Wells Fargo all report with first quarter numbers on Friday the 12th of April. The news flow may be a little bit quieter in the UK in the coming week, but it should be no less informative for that. Government bond and commodity markets now look to be actively considering the prospect that the US economy at least could run hotter than expected, with the result that inflation will stay higher than expected for longer and interest rates will do the same. US Treasury yields are rising, so prices are falling, while commodities such as gold, silver, oil and copper look to be on the march. There's a similar debate active in the UK's financial markets as the Bank of England wrestles with the decision of when would be the best time to cut interest rates. Inflation may be their main guiding light here, but there are many others, one of which is unemployment, as a tight jobs market will drive wage growth, and wage growth can be one factor in inflation. According to the data from the Office for National Statistics, the 3 months to January, the unemployment rate remains low in the UK by historic standards at 3.9%, and the employment rate relatively high at 75%. Meanwhile, wage growth remains robust at 5.6% year on year, including bonuses. However, the number of job vacancies has slipped by almost a third to just over 900,000 from the 2022 peak of 1.3 million, and the UK did fall into recession in the second half of 2023. That tallied with the picture painted by the three FTSE all-share recruitment agencies, Robert Walters, Page Group and Hayes, who all noted a marked slowdown in activity in 2023, particularly in the second half. So their updates for the first quarter of calendar 2024 on the 15th, 16th and 17th of April respectively could be particularly informative. Now, Robert Walters put out a profit warning last June, and earnings estimates have continued to leak lower ever since, while Hayes and Page Group both coughed up a trading alert in early January of this year, when both cited a weak December and a poor end to the fourth quarter of calendar 2023. There were three other common themes across all of those statements. The first, a swing in hiring activity toward temporary rather than permanent staff, usually a sign of low corporate confidence, although Hayes has the greatest exposure to temporary hires, which also represent around a third of fees at Robert Walters. The second theme was particular signs of weaknesses in the UK, America and China. And also the third one was decreases in their own headcount, in some cases through natural attrition, as if to suggest the recruiters themselves were preparing for tougher times ahead. Now, for all of that, Page Group shares have moved a little bit higher of late, although Robert Walters and Hayes shares have both lost ground. This sets the scene for these updates, which will represent the first quarter of the financial year for Page Group and Robert Walters, and the third quarter of Hayes' fiscal year, which runs to June. Now, the headline numbers which analysts will turn first is that of net fee income, and the year-on-year change in that figure, which for the companies as a whole, and also by region. Now, in the last quarter of calendar 2023, all three showed a decline on a constant currency basis, Page Group by 9%, Robert Walters and Hayes by 10% each. At Robert Walters, the rate of decline did at least ease, and the other two it got worse. Attention will then turn to the geographic performance trends, and in particular how the UK is doing, although we must bear in mind that the UK is just a fifth of sales or less at all three firms. Analysts will then look at any variance in trends between permanent and temporary staff, which are disclosed by Page Group and by Hayes. Improved momentum in permanent hirings could be a sign of improved corporate confidence, but persistent strength in temporary posts could suggest the opposite, and Hayes even flagged weakness in temporary positions late on in 2023. All three firms felt confident enough to run share buybacks or issue a special dividend thanks to their net cash balance sheets in their previous financial year. So watch out for any commentary on cash returns or financial guidance more widely. Although in the case of Page Group and Robert Walters, it might be a little bit early in the year for that. All three are currently expected by analysts to report a mid to high single-digit percentage drop in their revenues for the year that's about to start, or end in Hayes' case, while Hayes and Page Group are expected to report lower full-year profits and dividends, in contrast to Robert Walters, where consensus expect a modest recovery in profits for the year to December 2024, along with a slightly higher dividend payout. I hope that you and your families are all well and in good spirits. Thank you for watching, and I look forward to seeing you again next time.